Hey friends, I'm back with another video. I just got home from Hawaii. I've been spending the last week researching this video. There's a new stock, a dividend stock, a fast growth dividend stock that I have been analyzing that I am considering initiating a position in. Now, I was inspired to look into this company by my vacation in Hawaii because this company plays a direct role in our vacationing in Hawaii. A lot of you may already know that I own over 50 dividend-paying stocks, and 2 of those stocks happen to be Hawaiian-based companies. So if I purchase this one, it would be the 3rd Hawaiian-related company you'll see in a minute. But first, as you can see on the screen right now, I want to share with all of you the 2 existing companies that I own that are based out of Hawaii. You can see on the screen in front of you right now, Bank of Hawaii and Hawaiian Electric. Both of these companies I've been in for a long time. Bank of Hawaii I started buying in 2014 in the $56 range. Hawaiian Electric I started buying in 2010 in the $20 range. Both of those have a current yield of over 3%. And both of them have been solid investments for me. A lower risk investment, solid cash flow, the types of investments that I like. But perhaps what I like most about these 2 companies is they help me invest in something I'm very passionate about, which is Hawaii. We love vacationing in Hawaii. We wish we could do it even more than we already are. And so by owning these 2 companies, it kind of connects me to Hawaii, but it also puts me in 2 companies that I will never sell. One of the things that is so important to me as a long-term dividend stock investor is to have that persistence, to stay in the companies that I own for very, very long periods of time, or what I like to say, forever. I am not going to sell these companies. I don't plan on selling these companies. And because I have that emotional attachment to them on some levels, that makes that persistence even stronger than it would be otherwise. And so that's why I love these companies, but they're also fundamentally really solid. Of course, there has to be passion combined with fundamentals for a really good dividend stock for a long-term buy and hold forever investor. Anyway, when I was in Hawaii, believe it or not, you may know this actually. Put it in the comments below if you already knew this. As some of my OG Thug Life investors here on PPCE, and I talked about this a long time ago. It was actually in one of my dividend videos about some investing mistakes I made. And at the time I was thinking, is it a mistake? Is it not a mistake? Long story short, we are owners in vacation ownership. And this is also known as timeshares. I wouldn't consider this to be a long-term investment of any sorts, but I would look at it as a luxury purchase, similar to buying a fine automobile like a Mercedes-Benz or a BMW or a Porsche. That's kind of how I look at vacation ownership. It's a luxury purchase. It's a lifestyle purchase for enjoying the finer things in life. Anyway, we purchased that a number of years ago. I covered it on my channel a long time ago. I might cover an updated video on it though, because what's happened, because inflation has hit so hard here in America and also worldwide, everything the timeshare sales representatives told us at the time, that the cost of hotel rooms, the cost of these villas would go through the roof, they were actually right. I don't think at the time that they could have forecasted what would happen in our society and what would happen with the cost of hotel rooms. But needless to say, because we purchased vacation ownership a number of years ago, we locked in a lower price on hotel rooms, on the villa rooms, which is much, much lower than the current going rate. And it actually worked out really favorably for us. I think there's another trend where people of my generation, the millennial generation, I'm one of the oldest millennials, we enjoy travel, and despite where the economy is, we want to enjoy some of those finer things in life, and vacation ownership can make that more attainable on a more regular schedule for many consumers like our family. And so this is a really long introduction, but the stock that I want to go through in great detail today is the Marriott company, but there's actually 2 Marriott companies. And so as you can see on the screen in front of you right now, I'm going to go through this in quite some detail, but there's the Marriott International Inc. That is the big kind of hotel management company. But the one I'm actually going to review today is Marriott Vacations Worldwide, ticker VAC. And so Marriott Vacations Worldwide, this is a company basically that has rolled up the entire timeshare or vacation vacation ownership industry, more or less. This has been a standalone entity kind of trading on its own separately from Marriott International, I believe since about 2011, and the stock has done well. The dividend growth has been through the roof, and the business is doing well. And so in the video today, there's of course also going to be some words of caution, and I'm going to point out where I see the risks with this company. But I figure as a vacation ownership family, why don't we also participate in the success of the company behind all of this? And so I want to get into this in a lot more detail. Get ready, everyone, for a really exciting dividend investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So the first thing I want to ask you to do, if you enjoy these videos about dividend stocks on my channel, please go ahead and smash the like button. It means the world to me. I put so many hours of research into this video on the airplane home, here once I got home, and just today getting everything set up. And then I'm going to go into editing once this video is filmed. Please don't forget to subscribe as well. And check out the pinned comment. I have a link there to my Patreon, which with a huge amount of bonus content over there on Patreon. So without further ado, what I want to do is share the numbers. Check it out on the screen right now. What I'm going to do is I'm going to get into the numbers, and then I'm going to get into some slides. I have a lot of ground to cover. We're still in the last week here before school starts, and so I have a brief moment here where I have the house to myself and there's no noises, and so I'm trying to do this in one take. Hopefully it all works out. I don't have ability to film this video more than once, and let's do it. So Marriott Vacations Worldwide, as you can see on the left-hand column of this screen, is trading at $150. It was $144 range just last week, but it's gone up because their Q2 earnings were strong and the analysts are revising their EPS estimates up. Now, worth noting, in the depths of the pandemic, when no one was able to travel, this was trading at $50. And so it has tripled since then. And so that's my first word of caution, is I'm always skeptical about buying something that's gone up so quickly. And surely if we hit another pandemic type situation, folks aren't able to travel due to health concerns or economic concerns, boy, it could go down quite a bit. Now, based on the forward earnings estimates, it's trading at a PE this year of 15, a PE next year of 12. Now, I highlight that and I love that, but worth noting, this is the type of business that carries some risk. It's boom or bust. During an okay economy or good economy, it's going to do well. During a bad economy or a pandemic, it is going to be terrible. It's consumer discretionary. It's a nice thing to have. As I mentioned earlier, it's a luxury item. Now, thankfully, because Marriott Vacations Worldwide caters towards the luxury crowd within the timeshare industry. We'll talk about that in a minute. The credit rating of their customers is really high. So the type of customers they have that are buying these timeshares, this isn't your old school timeshare. The average customer that they're signing up is spending $60,000 with them. I'll get to that in a minute. Their dividend is 62 cents a quarter, comes out to $248 a year. And so the starting yield is really low at 1.65%. 25% payout ratio. Worth noting, there was only one quarterly payout in 2020 and two in 2021, so they did kind of pause dividends during the pandemic because they're in an industry much like Cedar Fair, that hospitality and travel and entertainment industry that was hit so hard. And so that's another word of caution. As I go through any new company, I get excited about it. I have an emotional attachment to this. I love the experiences that they provide to our family and to 700,000 other families. But quite frankly, there's a lot of parallels here to Cedar Fair. Am I getting into another Cedar Fair, which is a stock I bought and sold? And so I always have to also weigh out the words of caution and the risks as I go through things. Now, what I like about this company is despite the pause in dividends during the pandemic, their 5-year dividend compound annual average growth rate on the dividends is 12% per year on average. I think that could continue because the payout ratio is low as long as we don't hit another pandemic, as long as we don't hit some terrible economic situation. Look, interest rates could also go up quite a bit, and that could affect their business as well. On a 7-year basis, I looked, and the compound annual growth rate of the dividend is 13.9%. So the metrics that I like to look at are strong. $6 billion company, and I put some price divided by adjusted free cash flow is there as well. It's trading at 9 times adjusted free cash flow. Now, I'm going to get into this in a lot of detail later, but they have a balance sheet. And on that balance sheet, it shows their assets, their liability. And long story short, their assets are coming in at around $9 billion. And the liabilities are $6.5 billion. But at a top level, I look at that as being a little bit kind of maybe too good to be true. Is the shareholders' equity really what it appears to be there, which is assets minus liabilities? Not necessarily. So I'm kind of looking at a true equity. And look, they have on their assets about $2 billion of vacation ownership notes receivable. What vacation ownership notes receivable means is they sold a timeshare to someone, and that timeshare was financed by the person or the family purchasing it, usually at a reasonably high interest rate. I think those rates are traditionally higher than a mortgage interest rate. And this is, they have notes receivable of $2 billion. Now, keep in mind, if the person who has the note goes delinquent on the note, look, they could probably just repossess the timeshare, and the timeshare is just a right to use a week at a resort, for example, that has 1,000 rooms, for example. That's probably pretty easy to repossess, and it's going to have probably the same fair value at which they sold it at. And so I guess there's a little bit less risk to vacation notes receivable than maybe if this company was selling yachts or something like that, where you're repossessing a yacht. It may be very illiquid, more difficult to resell something like that, and it may even depreciate a lot more in value than the vacation ownership. But I'll get more to that later. They have goodwill. They've made a lot of acquisitions. Like I said, they rolled up the whole industry. If I discount that goodwill by 75% and their intangibles by 75%, long story short, I get true assets of about $5.7 billion. So I get a negative equity. Now, am I being too aggressive on discounting? Probably, but I'm trying to be realistic, because if I do buy this stock, I want to go in eyes wide open with all the risks and not fool myself. Now, I have a few notes below. The main notes are what I just covered. Is there too many similarities to Cedar Fair? I would say the big difference between this and Cedar Fair is this is an asset-light company, whereas Cedar Fair is an asset-heavy company. We'll get to that in a minute. But this is more of an asset-light company, which I am excited about. They don't have the debt burdens necessarily that a real estate play like Cedar Fair might have. Of course, they pause dividends. This is a boom or bust company. It might not provide as much stable cash flow as some of my other holdings, but that being said, it could provide some serious dividend growth because this is a company growing, and I think they have a lot of tailwinds in their favor. Is the balance sheet strong enough? Can owners, vacation owners, pay down debt that they might have in a rising interest rate environment? Now, I do have Marriott International as a comp on the right-hand side of the screen. I don't need to get into those numbers really too much at all, but peruse it on your own time. Take a look. Let me know what you think in the comments section below. Now, before I go on at all in this video, I'm talking about vacation ownership. I'm talking about financing vacation ownership. The first thing I want to say, as I did earlier in the video, is I believe vacation ownership is a luxury purchase similar to buying a fancy car, like a Mercedes, a Lexus, Porsche, BMW, something like that. And always, as a steward of finances and someone that wants to practice good financial management, my suggestion always for my family at least, in general, as a best practice when purchasing luxury items, is it would never make sense to finance something like that, in my humble opinion. Maybe it would in some rare cases where if an automobile is being purchased by a business and it made sense to finance it or lease it. But I'm saying in general, just boiling things down to the basics, in general, for myself, I don't like to purchase a luxury item unless I have the cash sitting there to pay it off. It would not make sense as a best practice, in my humble opinion, to purchase a luxury purchase like a timeshare and necessarily finance it more than temporarily if it took a little bit of time to just get the money in order to pay it off. But in general, I think that's really worth mentioning here, because this is a channel about personal finance, dividend stock investing, and purchasing a timeshare at an interest rate that might be higher than a mortgage interest rate without having the cash to pay it off pretty quickly. That is not necessarily a financial best practice, in my humble opinion. But anyway, as you can see on their balance sheet, there are folks that do that because they have some vacation notes receivable, and that's just part of the business they're in, and some folks choose to do that. Everyone is free to make their own decisions out there. And so I want to go through some slides. I have a lot to cover in the video today. I hope you enjoy it so far. This is a very extremely interesting topic to me. Put in the comments below if you want to hear more in a separate video just about our experience with vacation ownership, why it makes sense to us, why we like it. In a nutshell, I can give you maybe a top few bullet points right now. Bullet point number one is it allows me to book our vacation up to 12 months out. So it guarantees us a really nice room in the resort in Hawaii, or other places in the world if we want to go to another resort. So it gives us that 12-month window, which is good in today's climate where it's difficult to book hotel rooms and villas, accommodations, because everyone is traveling. I would say the second reason I like it is it gets us just on a schedule. It kind of forces us to go on vacation. Because we have it, we got to use it. And sometimes I get so caught up in work that we might be reluctant to go on vacation. I would say three, it just makes our day-to-day budgeting easier because I've already kind of paid it up front. Yes, there's maintenance fees each year, but I've paid the bulk of the expense up front, that it's kind of takes something out of the budget, takes that worry out of the budget more or less. I would say maybe four, something else we really love about vacation ownership is typically with the company we're with, which is Vistana, which was acquired by this Marriott group. It's all been rolled up at this point. The villas are really large, and so you can get like a 2-bedroom accommodation that has, it's kind of like a condominium style with a kitchen and living room, all the space that you need for your family, and it's right on the beach. And so there's a lot of good things, but if you want me to go through more of our experience with it, I'm happy to share that in a separate video. Let me know in the comments below. Again, it's a luxury purchase for us. And so I want to keep going. As you can see on the screen in front of you right now, I want to share just like what is the vacation ownership industry, because I have a lot of viewers on this channel from all over the world. I'm so grateful for all of you. I don't need to go through all the text here, so throughout the video today, please feel free. You could just pause the video and read it if you want, but this gives a brief history of what it is. This is from their annual report from the Marriott Vacations VAC Worldwide company, ticker VAC, and it just shows that it's traditionally known as the timeshare industry, and basically what they let you do is they can purchase an interest that's either a real estate ownership interest or a right to use interest in a single resort or a collection of properties. And typically the way it works with Vistana historically, and they're moving this now due to the roll-up with Marriott, but you can basically buy these points. And these points will allow you to reserve a certain type of villa at a certain type of resort. And traditionally the way it's been sold is deeded real estate. And so there you purchase these points, you're going to get a title report, you're going to get title insurance, and it's going to be deeded real estate, a fractional interest in the right to use a certain property. But again, you can exchange that on their system if you want to go somewhere else. They're moving more to a points-based system with Marriott. That's one of the big things one of the big initiatives right now that they just rolled out recently. There are actually some balloons there when we were in Hawaii to celebrate this this big rollout, but the new points-based system, which is kind of the future of the company, is a little more flexible. It's not necessarily that you're buying points at a specific home resort anymore, but it's more that going forward, people purchasing this vacation ownership are just buying points in a pool of points, which they can then decide which resort they want to go to throughout the world. Now, there's pros and cons to both of these, and I can share that in another video. There's way too much to cover today. But basically, vacation ownership, that's what it is in a nutshell. Let's keep going. As you can see on the screen, on the next screen right now, how do they make their money? And so this cost reimbursements, you can ignore that because it shows up in assets and liabilities. There's no profit on cost reimbursements. This is the resorts themselves reimbursing Marriott Vacations Worldwide for certain costs. And so really how they're making money is they are selling vacation ownership products. This is a sales organization. This is important. We start looking, what the heck could go wrong here? Well, what could go wrong is if our economy softens or interest rates, the almighty Federal Reserve increases interest rates too much, and we know that certain folks from the balance sheet finance these products, sales might go down, and this is a sales company. They thrive on sales of timeshares. If the sales slow down, the revenue slows down, the business slows down. Now, thankfully, they're getting into some resort management and other services. That's a good chunk of their revenues, rentals and financing. And so they also purchased the Interval International, which is basically a network where folks can take their timeshare and exchange it with an owner of another one if they want to basically go somewhere different in the world or the country than they're used to going. They bought that as well. And so they're getting into some ancillary businesses that help diversify their revenues during even weaker times when there's not as much sales. But this is, long story short, a sales-based organization. And boy, those sales better keep up. What's interesting is they have over 120 resorts and approximately 700,000 owner families. And so that just gives you a sense that, boy, there's a lot of room for growth at this company. 700,000 is not a lot of customers when you think of it, but these are 700,000 families that are, I would say, of higher income in general. You'll see that on the credit rating in a minute. And so these are good customers to have. These are customers generally that even if the economy goes pretty bad, they should be okay. And so that gives me some comfort that they've really focused their business more on the luxury segment. And so I want to keep going. I've got like 14 of these slides to go through. A lot of good stuff today. Put in the comments below what you think so far. If you enjoy the video, it means the world to me, as you can see on the screen in front of you right now. The next one is just some strategy. So on this strategy slide, it shows a few things about what the company is focused on right now. And it shows that they're basically trying to grow recurring revenues. This is something I got to in a minute ago. Basically, sales is pretty intensive. Sales is something that's one and done. Well, not necessarily, because you sell to a new family and they probably end up buying more and more and more, as I saw in another slide. But basically, sales is really capital intensive, and so they're trying to move more to a recurring revenue model. And some of the ways they're doing that is just through, like I mentioned, their Interval International acquisition. They're trying to focus on younger customers, and I think that's really important. I saw on another slide, it's not here, but they're starting to attract a lot of millennials. I think about 1/4 of new sales at this company are now the millennial generation. I thought that was really nice, because sometimes you think of timeshares and you just think of grandmas and grandpas purchasing a timeshare so their whole family can enjoy a vacation, but it's not necessarily that even anymore. I'm living proof of that. My family is living proof of that. They're trying to maximize cash flow. They're moving more to a points-based products, which is allowing them to really resonate with millennials, have a business model that resonates with customers who want to go to many different types of resorts and not be pegged into any one type of resort. Their business model is characterized by steady, consistent cash flow, and they are an asset-light, capital-efficient framework. And I think that's really important. I could dig down into that in an entire separate video, but honestly, I want to try to keep this video under a half hour if I can. But basically what they're doing is this is not a company that just owns a bunch of real estate and rents it out. This is a company that develops real estate or acquires real estate, converts it into timeshares, and then basically sells off those timeshares in pieces. And so the amount of real estate that they end up holding on their balance sheet, it's not huge. And therefore the amount of debt they have on their balance sheet, it's not as huge as if this was just, say, a hotel. It's a different type of company. It's an asset light company. And we've seen in recent years, especially with the technology industry, that it's the networks, it's the exchanges, it's the companies that provide networks of scale that thrive so much in the modern economy. And so I don't mind that it's an asset-light company. I look at it more as an experiences company. I look at it as a kind of a premium quality of lifestyle, luxury type company. I look at it as a luxury goods of sorts, and I look at it as a tech company of sorts. It's not there yet. They have a long way to go, but they're finally starting to integrate everything and become more of a network at scale using technology to fulfill people's vacations and their luxury vacations. So let's keep going. As you can see on the screen now on the next one, I want to go through some of their competitive strengths. They're the leading global vacation ownership and exchange company. Huge company. They've rolled up the entire industry. We're talking about brands here like Marriott, Westin, Sheraton, Hyatt. These are the brands of choice, in my humble opinion, when it comes to premium hotel or villa-based travel. And so as I mentioned in the intro way back in this video, they just announced their Q2 earnings, and I want to share that because they've been really good. You would think, hey, our economy is softening. Hey, the Fed is increasing interest rates. Hey, we're headed to a recession. Well, the numbers here show otherwise. Check it out on the screen right now. As you can see on the screen right now, contract sales are up 506 million. It's a 40% increase compared to the second quarter of 2021. Honestly, I don't know what VPG is. I was trying to figure that out. If you know what VPG is, please put in the comments below. I was researching that. I could not figure that one out. You can basically see here that the company is returning $219 million to shareholders. They're repurchasing shares. They're paying a dividend, and this is a company that is really focused on its shareholders. And I don't have too many numbers here on 2019, but all the way at the bottom, they also say that contract sales and adjusted EBITDA, there it is, adjusted EBITDA is up 31% from the second quarter of 2019. So they're up versus 2019 as well. And so they're trying to compare, like, what are things looking like not only versus 2020, which was a tough year, but also versus that pre-pandemic era. And so what I would almost say these days, and I don't know if you see that out there, it's a weird society we live in, and you kind of see a bifurcated society. Like on one side of things, you hear about the high interest rates, you hear about terrible economy, you hear about layoffs, which are terrible. I was laid off once. I'll link in the pinned comment below. It's one of the worst experiences of my life, and that's one of the reasons I'm so passionate about dividend stock investing, because it gives me peace of mind. I don't have to worry as much about job security by having dividends come in. And so but you have another part of society, whether they just have a lot more money or they're kind of digging into their pockets maybe a little bit more than they should. They're just living their best life. And you kind of see that in these numbers here, that it's like, on the one hand, you hear the talking heads on TV telling us that everything is bad. But on the other hand, you hear companies like Marriott Vacations Worldwide are just thriving with their timeshare sales. And so someone out there is doing really well right now and purchasing more luxury items. And I think we see that as well just in society right now with fine watches right now are very difficult to get. They're really only pre-owned is available when you purchase a fine watch these days, like Rolex. They are sold out at stores. We went into a watch store recently when we were in Hawaii, and there were some Rolex watches in the display case, but they said these are just on a kind of display. It's more of for fun, just for people to see what it looks like, but they're not for sale, actually. They're not part of their sales inventory. They only have pre-owned ones for sale. And so you see this with fine luxury items now. If you go in to like a Louis Vuitton store, for example, or even to their website, some of the items, they're just sold out. You can't get them. They're gone. And so you have kind of a bifurcated society society. It's really weird out there, but I think what plays in Marriott Vacation Worldwide favor is they play towards kind of this luxury segment, this high credit score segment, this wealthy segment, and it seems to be working fine for them right now, even though rates are going up as we see in these numbers from Q2. As I want to share on the next slide in front of you right now, check it out. Here we go. Strong numbers. 2019, this is what I was looking for. Contract sales are up. Adjusted EBITDA is up. Free cash flow is up. They are growing versus 2019. So, and the compound annual growth rates are strong too, especially adjusted free cash flow is 15% compound annual growth rate despite the slump in 2020 and 2021. And so I want to keep going. Boy, this stuff is interesting to me. Share in the comments below what you think. And as you can see on the next screen, I want to share what's their addressable market? Who are they going after? Well, there's 38 million households that they believe is their addressable market in the US alone. The annual median income of these households is upwards of $130,000 a year. So these are very strong earning households in the United States. And I would say the FICO score, this is the one that really stood out to me. This is an exceptional FICO score. On average of these families is 735. Median net worth, 1.5 million. This is their addressable market. And of this addressable market, they have acquired so far 700,000 families. And so they've got a lot more acquisition opportunities to go. And so I think there's a lot of growth ahead. And I'm thinking, look, in a bad economy, even the wealthiest of the wealthy, are they going to be buying these luxury experiences? That's what time will have to tell us. Historically, I would say probably they wouldn't. Now, though, I think the pandemic taught a lot of folks just to live for the present day. I know our family's trying to travel a little more than in the past, just to kind of look, we were at home a lot during the pandemic, and just like everyone else, we realized that everything that's guaranteed is just right in front of us right now. We don't know what's happening next year. We don't know the year after. Is there going to be another pandemic? No one knows. And so now is a good time just to enjoy life. And I think some folks are thinking of it that way as well. But if times get really tough, will folks still do this traveling? Boy, I don't know. I think this is certainly a stock that could face volatility in bad times. But as you can see on the screen in front of you, I want to underscore again that the FICO scores here, they talk about it, that their FICO scores are really strong. And so they have here the average FICO score of our customers who were U.S. citizens who financed vacation ownership was 732. They say 69% have a credit score over 700, 87 over 650, 96 over 600. And so they are underwriting their debt really well, and they're attracting the right kind of customers for the product they're selling. And honestly, they have to, because it's not a cheap product. As you can see on the next screen in front of you right now, they talk about adding engaged new owners. It drives their growth. And so there is a sales cycle. It's not one and done. On average, someone will spend $30,000 on their initial vacation ownership purchase. They'll own their vacation in perpetuity, and it's deeded and basically can be passed on to future generations. Now, there are downsides. It also passes on maintenance fees in perpetuity, and the maintenance fees can be high. And so that's something to consider in the analysis as well. Put in the comments below if you want me to share in a future video just some numbers and what it looks like, how it pencils out on these vacation ownerships with the maintenance fees and everything put in there. But long story short, what they're saying here is on average through the first 5 years, they're able to basically engage and drive revenue growth through their new customers. And the biggest one is they're able to add on another 20K just through an additional purchase. And so this is a pretty big deal here, that it's not just a sales cycle, one and done. Hey, I sold you a timeshare, buy. No, it's like, hey, I sold you a timeshare, and the person who bought the timeshare loves the timeshare so much that they are seeking out to buy more timeshare because they want more of what they're getting. And honestly, that's what our family want. We enjoy the experience so much. It is so amazing. It is really living our best life that we want more and more and more. And so it is, Marriott Vacations Worldwide is crafting these really luxury dream experiences that folks are enjoying. And so let's keep going. As you can see on the next screen right now, I want to share their balance sheet. They're calling it a conservative balance sheet. The interest rates are primarily fixed. Now, this is on corporate debt. They have 2.7 net corporate debt, 3.3% weighted average cost, 91% of that is fixed. And you can see their debt stack there. And so I like this part of the debt sheet, but there's another part of their debt sheet, their balance sheet, or the debt stack on their balance sheet, but they also have securitized some of their timeshare notes. And so I want to get into this in a minute. As you can see on the screen, this took me some time to figure out. I'm telling you, I did a lot of research for this. Check it out on the screen right now. The next one I want to share is the balance sheet securitization. And what basically they do to shore up liquidity is a few things. Well, they have some cash, $324 million. They have notes receivable that are eligible for securitization, and they have a revolving credit facility. Now, what they're saying is the company completed its first timeshare receivable securitization in 2022 in the second quarter, and they issued 375 million notes backed by a pool of 383 million vacation ownership. Oh, so that's interesting. I guess they over-securitize it or over-collateralize it. I didn't even know that till looking at it right now. But it basically says the weighted average interest rate is 4.59%, and it has a gross advance rate of 98%. So what are they doing? Basically what they're doing is they sell a timeshare. A lot of people will take a loan on the timeshare. Not everyone, and some people take it with the expectation, hey, I'm going to pay it off in a few months. They're like, hey, I'm going to buy this. I have most of the cash to pay it off, but I'm going to get the rest of the cash in a month or two when my bonus comes around. And so they will finance it, or some people just want to finance it in perpetuity. I know that one of the sales representatives at the timeshare a long time ago told me that, hey, what some people do is they buy it, they go home, they take out a home equity line of credit on their home, and they use that to pay it off or whatnot. There's different ways that people, but that could take time, and there's just different ways people look at it. But needless to say, as you can see on the balance sheet in front of you right now, towards the top, it shows you on their assets, they have a big chunk of it that is vacation ownership notes receivable. And that's basically $2 billion of assets. Well, what this really is, to my understanding, and correct me in the comments if I'm wrong, but basically what it is it's folks that bought timeshares, they financed it, and these are literally the notes receivable. Now, there's some risk with this. The risk with this is, what if someone defaults? It's, I guess, not as bad as defaulting on an auto loan or a boat loan or something like that, or the loan for heavy machinery, because the company can repossess what they have here instantaneously. There's no worry about that, and they can just plug it into their existing sales system, because most of what's being sold here are floating weeks. You don't own a certain unit or a certain specific unit. Some people do, but it's rare. It's more that you're buying floating weeks, which is the ability to use a unit for a certain amount of time, and you get to pick a different week each year, whatever you want. And so there's that. But long story short, that's a lot of assets that are kind of riskier, as I mentioned earlier on in the video. And also, it kind of hampers liquidity in some ways, because it's illiquid. It's an illiquid asset. You have to wait for these notes to be paid off. But what they're able to do is they're able to go to the bond market. They're able to securitize these notes. They're able to over-collateralize them a little bit, and they're able to get an advance on that future stream of revenue. And that's what you see all the way at the bottom. You can see in the liabilities that they have debt, which is the $2.7 billion corporate debt, but you have securitized debt, which is at that interest rate for something that I just mentioned of $1.846 billion. And so that securitized debt, I looked into it even further, and it said it was non-recourse. And so I think they've actually removed their risk about owners defaulting on that, which is really awesome. But that's what they're doing there. When I first saw this securitized debt, I thought, is that good or bad? I kind of thought maybe it's bad. The more I looked into it, I think it's good, because it seems like they're using that to reduce risk. They're using it to advance themselves some money that they can use to grow the business, and it's at a reasonably low interest rate. And so that's where I'm at with the Marriott Vacations Worldwide balance sheet. Now, if I were to take a step back and sum all of this up, I got a lot of passion around this company. I love Hawaii. I love vacationing. As I'm now in my 40s, I want to vacation more than ever. I just eat this stuff up. I live it. I love it. When I'm not here on YouTube, when I'm not with my family, when I'm not working, sometimes you'll just find me on TripAdvisor just daydreaming about where we could travel. And so that is a passion of mine. And it's because it's tied into Hawaii, I love it even more. That skews my mind on this investment. So put in the comments below if you think it's a mistake to buy this thing. It skews my mind, and I know that getting in. But two, it's a good thing because if I buy it, I have more of an attachment to it than like Cedar Fair, which I sold. I didn't have as much of an attachment to that. I love their parks. I've been to Knott's Berry Farm before, but I don't really go there much anymore. It's not a passion like Hawaii is for us, or travel in general. I think there's pros here. I think they have a really, really old school business that but they rolled up the whole industry, and they're starting to go digital, and they're starting to attract millennials like myself, my family. And so they have a lot going in their favor right now. They're on the cusp of something grand, in my humble opinion, and it's just getting started. We're already seeing that in the fabulous numbers. We're already seeing that in the compound annual growth rate numbers. I think their balance sheet is okay enough. I like that they're aiming to be in asset light. They're not looking to take on a ton of debt and finance a ton of real estate. It seems like they're able to kind of work with the existing network of properties they have, and they can sell more vacation ownership just at the properties they already have. It sounds like that's more of the strategy now than developing net new real estate. I know on the Ka'anapali Beach in Hawaii, there's no more real estate for them to develop. They've already developed 3 phases. They did the Westin Ka'anapali Ocean Resort Villas, then they did the north segment of that resort, and then they did the Nanea. There's no more room. There's nowhere for them to build there, at least on Ka'anapali Beach in Hawaii. And so it seems like they're taking the right direction strategically with their business. I think risk factors is, boy, they are relying on folks who finance these timeshares. They sure have good FICO scores. They sure have great net worth. But when times get really hard, if we're headed into the second Great Depression, for example, I think companies like Altria, which is one that I own, will weather the storm a lot better than vacation ownership. Because I think if things get that bad, people are just going to hunker down. And if they have to choose between paying their mortgage or paying their vacation ownership off, they're just going to lose their vacation ownership. And honestly, the company probably won't be able to sell it easily to anyone else. And so this is a bet on long-term America doing well, continuing to grow, and continuing to be a somewhat decent operational economy. But if you feel the wheels are going to fall off, this is probably not a good-looking prospective investment. But also, I would say, taking a step back, I own over 50 dividend stocks. Quite frankly, my entire portfolio is a bet on the economy. If we head into the second Great Depression, some stocks will get hit worse than others, but even Altria will get hit hard. So what am I going to do? I don't even know yet. I'm going to sleep on it. But I'm kind of thinking of taking a small position for fun. I have to stay focused on my core stocks, but let me know what you think in the comments below. I love you all. Don't forget to smash the like button if you enjoyed the video today. Don't forget to subscribe. I have new videos on the way all the time. I spend so much time on these videos because I love you all. I love this community. In terms of full disclosure, I am long Bank of Hawaii, BOH. I'm long Hawaiian Electric, HE, and I'm long Altria, ticker MO. And it is likely I will probably initiate a position sometime in the next few weeks on Marriott Vacations Worldwide, ticker VAC. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. Just sharing my journey here on YouTube for fun and entertainment. As you've all seen, I share my mistakes. I share my successes. I'm sharing it all, just one person's journey for fun and entertainment. It's very important to consult your licensed financial advisor. Now, before I go to fun facts, I'm wearing this necklace today. This is my koa wood dog tag. This is from the island of Hawaii as well. That's why I have that on in the video today. And I want to share some closing inspiration, because when I'm on vacation, I always come up with some inspirational thoughts and I start thinking strategically. And I also try to have a hip hop tune that kind of sets the stage. I listen to it before filming these videos. It kind of sets the stage. Check it out on the screen right now. This is from Twitter. I shared this on Twitter the other day. I will link to my Twitter in the pinned comment, as I will link to my Patreon, where I have tons of bonus videos and stock trades. And at the corner patron level, I've got my complete dividend stock portfolio, percentage allocation to each position. You don't want to miss out on Patreon. But anyway, on Twitter, I put a quote from one of these amazing old school hip hop tunes, Lords of the Underground, What I'm After, Mr. Funk. He was saying, because I'm definitely not where I used to be, but I'm nowhere near where I want to be. I want to be able to go out and buy a golf range and still walk away with change. Until then, there's no time to be wasting, so I got to keep on chasing. This is where I'm at in life, and I imagine where a lot of you are in life as well. I am interested in continuing to stack those dividends to reach financial freedom, where I can just be traveling all the time on that fat fire. I love you all. I'll see you in the next video. I'll see you in the comments below. Have a wonderful day, everyone.